All right, welcome to The Explainer. Today, we're going to peel back the layers on gold. I mean, it's one of the oldest assets in the world, right? But here's the thing, we're not just talking about the shiny metal itself. We're diving deep into the massive, super complex, and honestly, pretty misunderstood market that sets its price.
You know, that one sentence, it perfectly captures this huge debate that's kind of raging just under the surface of the financial world. It gets at this fundamental split between owning a piece of paper that says you own gold and, actually holding the cold, hard metal in your hand. So yeah, let's get into it.
So, if I asked you how to invest in gold, the answer today probably seems super obvious, right? But it wasn't always this easy. Not at all. The way we all deal with gold has completely changed, especially in the last few decades. Okay, so on one side, you've got the old school way. You buy physical bars, you buy coins. That means finding a dealer, figuring out secure storage, paying for insurance. It's a process. But then, on the other side, you've got the new way, gold ETFs, exchange-traded funds. They basically promise you all the upside of gold's price, but with none of the headaches. You can do it with one click on your phone. But that convenience, it begs a really important question. What are you actually buying with that click?
And this is where things get interesting. Because when you start to dig into how these super convenient new products are actually structured, you find the first huge difference. And guess where it is? Yeah, it's buried deep in the fine print, the legal stuff nobody ever reads.
And this idea, counterparty risk, it's absolutely key. See, if you're holding a gold coin in your hand, there's no counterparty risk. It's just you and the coin. But with an ETF, whoa, it brings in this whole long chain of other parties, counterparties, that stand between you and the actual metal. Your investment's success now depends on every single one of them doing what they promised. So think about it this way. You're not just betting on the price of gold anymore. You're betting on the entire system that holds that ETF up. You have to trust the fund's managers, its legal setup, the bank that's supposed to be holding the gold, and a whole bunch of other links in the chain. And if just one of those links breaks, especially when things get chaotic in a crisis, well, your whole investment could be in jeopardy. And check this out. This quote isn't from some critic. It's pulled directly from the fund's own legal documents, the prospectus. They're basically admitting that if the gold gets lost or stolen, the responsible party might not have enough cash to cover the loss. And believe it or not, that's not even the scariest part. I mean, just let that sink in for a second. The bank that's supposed to be holding the gold can hire someone else to hold it for them, and that company can then hire another one, sometimes without even a written contract. The sources we looked at call this a game of liability hot potato. It's all designed to protect the fund and the managers, not you, the investor. Okay, so the big takeaway here is that these aren't just, what-if scenarios. This stuff has actually happened. Back in 2016, BlackRock's IAU, the world's second biggest gold ETF, literally sold hundreds of millions in shares it wasn't authorized to sell. For a little while, investors were watching the price of real gold go up while the value of their ETF was going down. So yeah, these administrative screw-ups are a real thing. All right, let's zoom out a bit. We've talked about the risks in a single fund. Now let's see how that scales up to the entire global market. And I got to warn you, this is where the numbers get absolutely mind-boggling.
So look at this number, 83 million ounces. That's it. That's the total amount of new physical gold that every single mine on the planet digs up in a whole year. It's a real, tangible, and finite amount.
Okay, now look at this number. This is where you really see the crazy difference in scale. In a single day, on just one exchange in London, traders are swapping paper claims worth more than 2 years of all the gold mined in the entire world. The amount of paper promises out there just completely dwarfs the amount of real physical metal. And it gets even crazier on the COMEX exchange. At one point, for every single ounce of real gold sitting in their vaults, ready to be delivered, there were almost 17 different paper claims for that same ounce. The only reason this whole system doesn't implode is because almost nobody ever asks for the physical gold. But what if they did? I mean, if even a tiny fraction of those people said, "Give me the metal," the vaults would be empty in a heartbeat. This quote from Kyle Bass just nails it, doesn't it? He gets right to the heart of the matter. The entire paper market is built on this one single assumption, that people will never, ever actually show up and demand the real thing. The question is, what happens when that assumption finally gets put to the test? So, okay, if the system is this leveraged up to the hilt, with way more paper claims than physical gold, you have to wonder, how do they keep the price from going completely haywire?
Well, it turns out the exchanges have some pretty powerful tricks up their sleeves.
To really get a feel for how this works, let's look at an example from our source material. Now, this is a hypothetical scenario involving the silver market set in 2025. In this story, silver prices just explode, surging over 147%. But look at the forecast from the big banks, the major players in these paper markets. They weren't just a little bit wrong, their predictions were from another planet entirely. It's a perfect illustration of this huge disconnect between the paper world and physical reality.
So when a price starts to move up way too fast, and it starts threatening the big banks who might be betting against it, the exchange can pull out what critics have nicknamed a kill switch. Now, that's not the official name, obviously, but it perfectly describes a very real tool they have.
Here's the playbook. The price is rocketing up. Then, boom, overnight, the exchange dramatically jacks up the margin requirement. That's the deposit you need to hold your position. Well, the smaller leveraged traders, they can't come up with that kind of cash on short notice, so they're forced to sell instantly. This flood of forced selling hits the market all at once and just slams the price right back down. Critics will tell you this isn't about managing risk, it's about protecting the big guys by changing the rules right in the middle of the game.
And again, this isn't just theory. To show the potential real-world damage, our source material gives us another fictional example, this one from early 2026. In this scenario, these rule changes had a real body count. 44 trading firms in India went bust in a single week. Why? Because they were holding paper bets that got absolutely annihilated by those margin hikes. They didn't have the physical bars.
So all of this leads us to the climax, a really dramatic case study from the source material, the fictional crash of January 2026. It's a what-if scenario, but it's specifically designed to show us what could happen when this super-leveraged paper system gets pushed right to the edge, and then over it.
So here's the scene. The market is red hot, everyone's euphoric. Then the news breaks. A new hawkish Fed chair nominee is announced. Now, that just means someone who's probably going to raise interest rates, which is usually bad news for gold. And just like that, the paper markets absolutely collapse. We're talking $3 trillion of paper value just gone, vanished in minutes. Looking at the screens, it was a total bloodbath. One of the worst crashes in decades.
But, and this is the absolute key, while all this was happening, while the paper price was cratering in New York down to around $78, guess what was happening in Shanghai? The price for actual physical delivery was trading at an $8 premium. Think about that. The physical buyers were basically ignoring the chaos in the paper casino. They were willing to pay more to get their hands on the real thing. When you boil it all down, what the sources are really showing us is a choice between two totally different ways of thinking. The paper promise gives you easy, convenient exposure to the price, but it completely relies on the financial system working as it should. Physical possession, on the other hand, that's about true ownership. It's an asset that's designed to hold its value specifically when that system starts to fall apart.
And that really leaves us with the big question, doesn't it? In our world of digital everything and incredibly complex financial products, what does it actually mean to own gold? Is it a ticker symbol on your screen? Super convenient, super easy, but loaded with all these hidden risks we've been talking about? Or is it a tangible asset, something you can physically hold in your hand, completely separate from the very system you might be trying to insure yourself against? That right there is the heart of the whole debate.